Dollar cost averaging. Regularly investing money in the market is an age-old strategy for mitigating investment price risk. Commonly applied by 401k plan savers, it could also be a useful strategy for experienced investors with larger sums of money, especially during periods of uncertainty or when emotional reluctance is high. Dollar cost averaging involves regularly investing a consistent amount of money to purchase a specific asset or group of assets, regardless of their price. For example, an employer-sponsored 401k plan is set up this way. With each paycheck, you invest a regular percentage, say 3 to 5%, of your earnings in defined assets, generally mutual funds or exchange-traded funds, that you have previously selected beforehand. This strategy helps prevent you from stressing over decisions on when to invest in the market. With a regular investment approach, you don't focus on whether the asset you're purchasing is at a good price for purchase. Rather than try to time the market, you buy it each week or month or whatever the interval is that you have chosen beforehand. The theory underpinning this strategy is that asset prices will go up and down in unpredictable ways. And if you buy shares regularly, the average share price you pay over time, that is the dollar cost average, won't be too high. When prices are lower, your money will buy more shares than the same amount will buy when prices are higher, bringing down your price per share cost. This, in turn, can help reduce the impact of market volatility on your overall portfolio, which is always a good thing. In addition to the theoretical benefit of avoiding an overly high purchase price, dollar cost averaging presents other potential benefits as well. For relatively early savers, regularly investing in the market builds the investing habit and may help you feel more at ease with investing in general as time goes on. For those with large cash balances, it can be a way to invest or reinvest. Cash tends to lose value over time thanks to inflation, especially as interest rates go down, cutting into your cash's return potential. Dollar cost averaging can help address the emotional challenge of loss aversion, which often has the potential to lead to inaction. However, dollar cost averaging could also leave some returns on the table. When markets are rallying, as it did in the past couple of years, and it does not mitigate some other investment risks. Given that time in the market is often an advantage, investing all your money at once could be more effective than investing it incrementally over time. This all-in approach is known as lump sum investing, and it does have its benefits. Lump sum investing can be an effective strategy given certain market conditions. For example, in a rising market, particular assets will rise in price on average. So investing a lump sum at the outset can enable you to acquire more shares and therefore more value, compared to investing fixed amounts over time. But if you invest all your money at once and the price drops, you may suffer losses that could persist for a few months or even a few years. Under these conditions, dollar cost averaging would lead to owning more shares. With dollar cost averaging, you can avoid the risk that you've mistimed the market. It's important to keep in mind, there's no one-size-fits-all answer when it comes to your investment strategy. Whether dollar cost averaging is the right strategy for your investment goals and time horizon depends on multiple factors, including your financial goals, your available cash, market conditions, and investment opportunities. If you or your family have any questions or would like to speak to my team and I to get your financial roadmap laid out, please don't hesitate to reach out anytime. And as always, thank you for watching and have a blessed day.